Good morning, everybody, and welcome. Thank you for attending our new not-for-profit reporting standard is now webinar today. I'm Mark Lockwitz. I'm a partner here at Costerisan, and I just want to thank you again for participating. So for today's agenda, just a brief overview as far as what's happening and how we got here, and then we'll go over the major changes and then some transition guidance as well. And this is a cartoon that I've had for years and years and years, and it's funny how it just still holds out there with some truth to it. So back in '93, the FASB put out FAS 117, which was the guidance that we used, through your last financial statements, or at least the last ones that you've seen as far as the reporting and how those look. And at the time, they were it was to enhance the relevance and understandability of the financial statements, and that guidance was about 70 pages in length to pretty much tell us how our reports need to look. So back in August of 2016, the FASB issued ASU 2016-14, been about 23 years at this time, to give us the new guidance to make it even more user-friendly and understandable. But as with all things, nothing ever gets shorter. Instead, we went to a whopping 264 pages in length, so quite a bit to push through there. So why the change? Well, the FASB and the NFP Advisory Committee just really sat down, and they just wanted something more useful to users, to make it more understandable, to give more transparency out there. And what they could agree on, they put in phase 1, which is what we're going to go over to today. And then phase 2 has a lot of other operational measures and maybe some other reporting changes that may or may not come down the road, if they can ever agree as far as how to put those in writing. So the effective date for the standard is beginning with fiscal years after 12/15/17. So the folks that have 12/31/2018 fiscal year ends, that will be the first time you'll be under this new reporting method. Now, that's not to say that you can't early adopt for those that say have a 9/30 fiscal year end, and we're not saying you should early adopt, but the absolute start deadline for those who don't early adopt will be this December's financial statements. So major changes. While these are the major change categories that we're going to cover today, not all of these are going to be significant for each non-for-profit. It really is a little bit different for each non-for-profit. So, and some of these changes aren't really as drastic as they may sound as major changes. So first area, we're going to cover the net assets. And under the current presentation, we have the unrestricted, temporarily and permanently restricted buckets that we're used to using and informing our readers, our board members, management, and all the other users. Well, those 3 buckets are now going to be reformatted, and now we're only going to have 2 buckets. The new presentation, there'll be a bucket for without donor restrictions. As you can see, that's where the unrestricted is going to go. And then a new bucket is the with donor restrictions, for the temporarily and the permanently restricted to be housed together. And we'll still have the required disclosures in your footnotes now, if it's not easily readable within the statement itself. Within the footnotes, right now we still have to break out the purpose of the temporary and the permanently restricted, what they're for, how they were released. We're still going to be presenting that information. So you still need to track all the restrictions and how it's spent and all the gifts. All that still needs to be tracked. But the reporting that we're going to see on the financial statements is going to be, confined down to 2 buckets here in essence, rather than 3. So just to give a little easy example of how that's going to look, here we've got 2 different presentations under the new format, as far as on your statement of financial position, as far as if you wanted a little bit more detail on the left, as far as what makes the without donor restrictions. That could be your undesignated or the designated by the board, and then if you wanted some more detail with your donor restrictions, you can see those there as well. And that line there saying perpetual in nature, that would be historically what you would refer to as like your endowments, you're permanently restricted, those that have a corpus that you're not allowed to touch. Or on your statement of financial position, you could go with a condensed reporting mechanism, which many organizations do use, where you just have the summary totals for both of those categories. And then in the footnotes, you would get broken out there and explained a bit farther. So you have plenty of freedom as far as which method you would like to choose. So the statement of activities, also very similar. You can still keep your desired format that you want. It's really the terminology change that will take place here, as you can see at the top, the without donor restrictions and the with donor restrictions. Now, the format that you see in front of you, I would probably refer to this as the best practice as far as how the statement of activities probably should look. So you can actually see on a column level as far as the without and the with donor restrictions, and then you get to see the grand total of all your contributions or all of your grants, but you get to see those bucketized and formatted here. Now, this isn't the required format for you to follow. Some organizations like a stacked approach where they have without donor restricted activity on top, and then underneath that they have the with donor restricted activity. If there was a best practice, this would be the format that you would be looking at. Now, as far as the net asset disclosure requirements, this isn't really new for the most part. We've always had to explain the composition of the net assets and net assets that were released as well. So we still had to explain that. So that part isn't really new, but there is more of an emphasis as far as maybe the board designated, maybe to get more descriptive related to the presentation of what makes up the designated and how its purpose is supposed to be used. So the presentation should emphasize how and when the net assets will be used. And as far as footnotes are concerned for the net asset disclosure, this would just be an example based upon, here we come to the grand total of 95,000. So if I back up a few slides here, we can see on here, on this slide to the left and right, that it's 95,000 is the with donor restrictions. So if we decided to go with more of a condensed version on the statement of financial position, as we see on the right here showing 95,000, we would be expected to break down the different details of what makes up that $95,000, as we can see here. And the top part, the subject to passage of time of 6,000, that would be something like your pledge receivables that you're waiting to receive in order to recategorize those for their purpose. And then we have our typical specified purpose restricted donations. And then at the bottom, where it talks about the spending policy and appropriation of investments in perpetuity, that would be typically what we're referring to as our endowment income, because that is in perpetuity rather than using the terminology permanently restricted. All right. Another option would be to, if perhaps you wanted to tell a story about your net asset disclosure requirements. So you do have some options as far as how you would like to present that. Most organizations probably do go with the numbers based, where we're lining up as the top presentation that we see there. But in some assets, it might be more apropos to basically tell a story as far as what the purpose is behind the board designated information. So you do have flexibility and options. One thing that has changed with regard to endowments under this new standard is, under the current methodology, when an endowment, an investment related to an endowment went underwater, meaning that the fair value of that investment was less than the actual corpus, the gift, the original gift that was received. And that's referred to as the endowment being underwater. This was experienced quite a bit, during 2008, 2009, maybe even a little bit in 2010 when the market dipped so drastically. It can also happen when you take an endowment's gift and you invest it, and then the next day the market really takes a 10% correction, and now that investment relating to that corpus gift is underwater for a little bit until the market corrects itself. So under the current practice, and what we've been doing is to keep the endowment whole. There's basically been, we'll call it an IOU for lack of a better word there, where the unrestricted fund would pick up the slack. As we can see here, we can see this $30,000 of unrestricted supporting the donor restricted related endowment fund. But really, there was an $80,000 value there between the two, only we're keeping the endowment whole, the temporary restricted of the 110,000. So this has been the current practice. Under the new reporting, we're no longer going to swap back and forth between the without and with donor restrictions, or using the current terms, we're not going to switch out between unrestricted and temporarily restricted anymore. Now we're going to keep all those losses within the restricted categories. As we can see here, we have the 80,000, which under the old method, we would have been splitting that out between temporarily and unrestricted category. So this is a slight change just to keep it within the nature of the restricted categories of net assets. In addition to this change, there is increased emphasis as far as explaining what the board's policy is and interpretation as far as how to spend from underwater endowments. So there should be a strong emphasis to review, the board's policy as far as how they plan to spend the endowment when we have some of the assets that are underwater. I mean, it doesn't mean that you can't. It all comes down to what your policy is, and I would say consult with your attorneys and go through that and see if you're allowed to. But for each year presented, you will need to explain, the fair value of the underwater endowment compared to what its original gift was, and basically the difference between those two is the deficiency. That amount will also need to be disclosed. So one example of that would be right here, where we talk about from time to time certain donor restricted endowments may fall fair values less than the amount required, and then we, the board, have interpreted a MIFA to permit spending from underwater. So depending upon how your policy plays out. And then we go on to explain, well, we try to put that in perspective. Well, how much underwater are we? So we look at the original gift value of 250, but it has a fair value of 220, so we have a deficit of 30,000. Here, I've given another example here of another way to tweak it for, say, a whole different scenario, but you can really go on to explain as much as you would like within this footnote. And here we can see at the very bottom, the very last sentence after the wording in red, where it goes on, and the board really wanted to explain, these deficiencies resulted from an unfavorable market fluctuation, that occurred shortly after the investment of new contributions. So here the board wanted to explain, why they were underwater, which, to their credit, does give more transparency and doesn't leave the reader to assume anything. So what to consider as far as net assets are concerned? Definitely review your classifications between the designated and the restricted there. Your underwater endowments, do you have any? Probably in this day and age, probably not with the way the market's been going for the past couple of years, but I would definitely, review your policies, maybe even update those to the board. It would be better to have that updated and that plan set in place before they do fall underwater, if we ever have another correction again. And this would also be a good time if you'd like to, really look at your financial statements, maybe gather some other different nonprofit financial statements from related organizations, maybe see how they're presenting their statement of financial position and statement of activities, and maybe it's time to tweak it to refresh your financial statements to really tell a good story and really represent your organization. And definitely communicate the terminology change. It's been nearly 25 years, and I still have to explain the difference between a temporary and a permanently restricted every now and then. So being able to really start that ball rolling down the hill to help everyone get used to using the terms of with donor and without donor restrictions would be very beneficial. So moving on, liquidity and availability. This far is probably the most sensitive topic and change with this new standard, and it's completely brand new. No one's ever had this footnote disclosure, so there's nothing to really base anybody's experience on. And one thing that I'll say right up front is that you could look at 100 audits and you'll probably see 100 different ways that this footnote is generated and displayed. So there really is no wrong way to throw this in the footnotes of your financial statements. I've given kind of the definition by the standard, as we can see here, and they're using the real technical terms of qualitative and quantitative, and they got a few other nickel words in there too. But in essence, in layman's terms, really what we're looking to do is, calculate from your statement of financial position the assets that you would be able to easily convert into cash within the next year. Okay? So by that being said, the ones that are easily converted to cash are definitely cash. Your receivables and your investments that are all, in that current category. Inventory and prepaid expenses, you've already spent the money for those, and now you're just looking to expense it over a period of time. So we're really looking at cash, receivables, and investments. And then related to that is we add or subtract based upon if there are any restrictions attached to those assets. So that's what we're looking to play with as far as the quantitative portion of this new footnote. The qualitative, in my terms, is really a story, or in some cases, for some nonprofits, a defense, because we're going to display this calculation and we're going to get to a number. And then the qualitative portion of this footnote, we're going to want to tell a story about this number and about the organization and what it plans to do to either with the money or plans to do to help supplement their dollar amount if they fall on a lower end as far as this calculation is concerned. But we definitely are going to be talking about the availability these financial statements have and their nature, their external limits, their internal limits. That's where it comes into play, is what we're going to add or subtract from this calculation. If there's board designations or donor restrictions, we're definitely going to have to remove those because we can't use those for a general purpose. And the general purpose is something that the nonprofit can use for whatever reason it wants. So there's really nothing attached to it. So that's the main goal behind this, to see how liquid an organization is for just some general expenses. And as far as the quantitative portion, I've kind of hit on some of this already, but we're really looking at cash, receivables, investments, and definitely excluding the prepaid expenses and inventory, as we've already spent the money for those. So here's just a little quick example of how this quantitative disclosure is going to work. So looking at this, notice we only have, the only long-term assets we have are property and equipment. And with this, we have cash, investments, receivables, inventories, and prepaid. So we're only using what we were allowed to, the cash, investments, and receivables. And that comes to up to about $123,000. So that's our starting point. And the reason why I like to tie it all into the statement of financial position is because then the reader, the board member, the grantor, if they want to figure out how you calculate it, they can kind of go back and forth and piece through it. It's very clear as far as where the numbers came from. So we're starting with this 123, which are considered our available financial assets at the moment. So on the actual disclosure itself, when we show the rest of the calculation, we're starting with our 123,000 here. But notice we are adding and subtracting various items. And I'm going to start with the 95,000 number. That's a similar number to what we had before when we were talking about the net assets, but contractual or donor imposed restrictions. So that 95,000 that we're subtracting here from the start, if we go back to the full page, that's our net assets with donor restrictions of 95,000. So since we don't have any other long-term assets, that would tell me that this 95,000 is strictly all up here in our current assets. So we're removing 100% of that 95,000 because that's got a certain purpose that it can be spent for. But we're going to add back 10,000 of that because the board has, through its budgeting process for the next year, decided to appropriate $10,000 related to the donor restrictions for general operations for the next year. So we do get to add back part of what's expected or budgeted to be used. And then the quasi-endowment fund and amounts set aside for liquidity reserve, both of those, the 3 and the 2,000, those are related to the board designated activity. So the quasi-endowment, the board has, $3,000 set aside for that, probably for scholarships or something along those lines. So we have to back that off because that's already been designated for a specific purpose. The same with the liquidity reserve. The board has designated a certain amount to make sure that we always have a set amount of money on hand. That's the amount that they've established. So we have to back all those out. So looking at this, we come down to financial assets available to meet cash needs for general expenditures within 1 year of only $33,000. Now, this is the whole number side of this whole footnote, the quantitative, just to come to this answer here of 33,000. We haven't done our defense yet or our storytelling, but in order to do that, we need to figure out what's the perspective that we need to tell a story. So this 33,000, the management and board are going to need to put that in perspective. Well, if we have 33,000 available to us, how can we put that in perspective with what we have here? So let's say, for example, that their annual expenses are, let's say, $200,000. All right, so that comes down to about $16,000 a month. So what that would tell me as a reader, just by doing some simple math, that as far as what assets they can use for general purposes, they only have about 2 months worth of liquidity. So that's where the story process starts. And then moving into the qualitative, the story, the defense in some cases, you can get as descriptive as you want, but really the point is just to tell a story as far as how your organization is handling this calculation that we see here. Now, in some instances, an organization is going to have a really high dollar amount that we're going to come to. And let's say you're an association and all of a sudden you calculated, I'll just throw out a $3 million number. I want to make it big enough. But say you're an association and you calculated this $3 million number. Well, your board and your management are going to want to tell a story to all of its users and readers, because your members that are paying dues, they might start balking and complaining if want to know, you're sitting on all this money right here. It says you've got $3 million you can use for general purposes. Why am I paying so much on a yearly basis? So you'll want to tell a story as far as what you plan on doing with this $3 million. What purpose is it going down the road? Is it for, a new addition down the road that you're saving up for? Is it to, start a new program, or et cetera? On the flip side, you might calculate a very low number. Let's say that instead of 33,000, let's say we got down to 2,000. Well, just looking at the numbers, that tells the reader that, wow, they really don't have anything on standby to help them in case they have a dire emergency and they gotta, spend some extra money. Where are they going to get it from? And it's also, people are going to read into that thinking that, wow, they really don't have anything to help them exist for the next year. Maybe they have a going concern issue. So there's a lot of storytelling that needs to come into play to put the reader into the right state of mind as far as how this new footnote disclosure is going to come into play. Now, this disclosure is not designed for you to produce a negative number here, but I do know of a couple of organizations that will have a negative number, because over the years they've designated and designated and designated, and they've never really quite adjusted it or come back to it and trued it up to the purpose. So they've over-designated. So they may come to a negative number once their board designated amounts have been backed out. So there's a bit of play that's going to need to take place there as far as your story to talk about what the board plans on doing. Or perhaps the board, when they first get the draft of this, they may decide to undesignate some of those amounts, and then we'll have to play with this disclosure to tell the story to represent that. But as far as the impact of changes are concerned, as I said, all nonprofits are going to be required to present the liquidity and this availability disclosure. And nonprofits with weak financial condition, they will be evident. So a story is going to be very key to explaining this new footnote. So what to consider? Presentation style. No mandatory style, as I said. You can see it a lot of different ways. The only requirement is, the numbers portion, and then basically the story. And then, will the nonprofit have ample resources? That's something the board and management to really take a look at. And then something that you may want to consider is as far as having availability to additional cash, you may want to disclose that, hey, we've got available $100,000 of our line of credit, or $2 million or $3 million, whatever you have it at, that we have available to us that we haven't drawn upon. So maybe that's part of your story to say, hey, you know, we're in a good situation. We can pull on money if we need to in case something happened. Other things to consider, you know, your policies and procedures regarding the restrictions. Should they be updated? Do you even have any? That would be something definitely to take a good look at and update or formulate those. And then another thing too is, has the board delegated the authority to management to designate and undesignate net assets, just to make it easier to make the changes if need be? If they have, you definitely need to have a written policy that's been board approved authorizing management. That is a necessity for that. And then another thing to consider, you know, do you have an operating reserve policy? That would be something to generally talk about when you're going over your policies and procedures. So definitely early discussion is necessary. Definitely explain the disclosure requirements, the best presentation. Definitely take an early look at this. I would heavily suggest, if anything, taking last year's financial statements and try to go through the calculation based upon the information that's in the statement of financial position and the information in your footnotes, and then add or subtract what, you know, that you had budgeted for this next year, just to kind of come to an estimated, you know, dollar amount, or maybe even project for this December where you might end up, or whatever your year end. Then kind of play with that. Perhaps even ask your auditors to take a look at that and try to help you through that, just to make sure that it all makes sense and the board has sufficient buy-in to this new footnote disclosure. But definitely, you know, talk to the board about it, recommend any policy changes or additions. Just letting you know there may be some, you know, additional costs relating to this new footnote, because it is brand new and there's going to be some time related to it. Expenses. So currently right now, not everybody has to present what's referred to as a statement of functional expenses. Right now, the only current requirement that all organizations have is basically a summarized report showing what the totals are for program and management in general and fundraising. But some nonprofits do have to produce what's referred to as a statement of functional expenses. It comes right after your statement of activities. Well, moving forward, everybody is going to have a statement of functional expenses to report. So there's no way around it anymore. And then the new format, you do have various ways that you can present it. You can, if it's small enough and condensed enough, you could theoretically put it within your statement of activities, as long as it doesn't make everything too muddled. Or you could have it in your footnotes if you wanted to. That's allowed, but the most common, the easiest way to go about it is just creating a new page that falls right after your statement of activities, and then just throwing in it there. But it definitely cannot be a supplementary schedule. It has to be part of the formal financial statements or footnotes. So the presentation, it has to include all expenses related to the statement of activities. And the reason why I put this slide in there is some organizations will net some of the costs with special events. Say you have a golf outing and there's some direct costs netted against that up in revenue. Well, those direct costs are going to have to be included on this statement of functional expenses. And then the other change, and I'll get more into this later, is that investment expenses are now required to be netted with the investment revenue. So before we had an option where we could, you know, do one or the other, either net them with revenue or throw them down into with all the other expenses. We just had to, you know, disclose that and show that. But now we're required to net all that with revenue. For those that aren't familiar with a statement of functional expenses, this is sort of a basic outline of what one would look like. And down the left-hand side, we have all the natural categories: salaries, occupancy, depreciation expense. And then we have, you know, within this matrix, we have all those bucketized amounts between what's related to programs, what's related to management in general and fundraising. Possibly have other categories, but it'll need to fall into that. And then here's where I was referring to before. If we have some amounts netted, with revenues, the expenses for those have to fall in here, and then we would subtract those amounts out, so we would get to our total here, so that our expenses would agree back to the statement of activities, but they do need to be included on a moving forward basis. So under reporting expenses, ASU 2016, it requires the notes to include more detail as to which type of expenses are allocated. So what this means is historically we've had a little footnote disclosure, explaining, hey, everything's been summarized on a functional basis. Well, now we need to get more detailed as far as how things are allocated, what is being allocated, which categories are being allocated. So we need to get a bit more expansive as far as our reporting. So here's one disclosure example of how, as you can see, the underlined amount here, where we're actually talking about the categories themselves and how they're being allocated. Depreciation on square footage, President's office, say on estimates of time and effort, time studies, payroll related activity, and then communication department, information technology, all those based upon time and effort. So there will be a methodology that needs to be updated and reflected as far as how we're going to do this allocation for some of the indirect costs for people and costs that are shared between program and then some that are management in general, and how that's allocated between the two. So for some organizations, this whole process for expenses will be much more involved than others. Some organizations have a chart of accounts where it's very detailed, very organized by certain programs in M&G, because they have certain grants that have to be recorded a certain way. Particularly if you have federal grants or state grants, you have to make sure that everything is allocated based upon the agreement. Other organizations are more on a summarized basis, so there'll be some allocation and some really good policies need to be instituted to really solidify the allocation method that's used when developing the financial statements. So just a refresher to assist those new and to help those understand that are completely new to the different functions and get a grasp of these changes. I threw in what's considered management and general activities, because that's the key to the whole allocation process. And it's pretty broad and straightforward at the same time, but anything dealing with oversight, business management, general record keeping, that's the accounting, payroll, managing payroll, budgeting, the list goes on and on and on. But this is a pretty straightforward list. If it falls into one of these categories here, it's going to be management and general. Employee benefits, HR, and then the catch-all, all other management and administrative except for direct conduct of program services. So anything that FASB couldn't throw into a certain bucket, they just threw in the catch-all here. So if it can't be specifically attached to a program or fundraising or membership development, by definition, it's management in general at that point. So definitely go through and maybe fine-tune your allocation process and really hone that in. So what to consider with reporting expenses? Definitely try to figure out what the best format is for you, if it's going to be the statement of activities or maybe in the footnotes, but more than likely it'll be its own statement. Do you need some assistance develop an allocation method? We're happy to help where we can with that. And then should the Form 990 be used? Absolutely. If you're creating this from scratch, I would definitely start with your Form 990, because those have the basic categories, and then use those at a bare minimum and then work through that to figure out how items will be allocated between the different categories. And then it might be a good time to really look at your chart of accounts to see if it's adequate enough to help streamline this allocation process to make it easier to manage on a regular basis. Investment return. This category will not be a real big change to anything that you're doing currently internal. Under the current method, we have to break out on the financial statements, what's interest, what's a dividend, what's unrealized, what's realized, investment expenses. We had to break that out. Under the new format, we can net that all together. We don't need to break that out anymore within the financial statements. We'll just show that as investment return net. So that's going to be the new minimum required disclosure. It's just on front of your statement of activities, investment return net, all that information, including the investment expenses themselves, all netted together. And then in the footnotes, we won't have the breakout anymore of dividends and interest and gains and losses. We won't have that disclosure anymore. Now that's the minimum requirement. If you choose to still, on your report, break those categories out, you can. It's going to be your choice and your board and your readers' best scenario to choose which one works best for you. But the minimum requirement is just netting it all together. Now, if you do decide to net it all together, please keep in mind that you still need to track dividends, interest, unrealized gains. Internally, you still need to track it all the same way you have been, because that information is necessary for when you're reporting your 990. So we're not getting away from recording that information. Now, investment expenses, there's really two categories. There's the external investment expenses, which is what most organizations incur, and that's what you're paying to a third party, whether it's Merrill Lynch or Raymond James or Comerica, whoever that might be. Those are external expenses, the fee that we pay to them. There's also the possibility of internal expenses. So if you have members of the organization who are actively, at the high level, actively developing and managing the investment strategy, the trading and such, and we're talking about the CIO, the CFO, the cost, a portion of their salaries, some allocation method needs to be developed, but a portion of their cost of salaries can be applied to the investment expenses, and it should be applied to the investment expenses. Now, this scenario I don't think is going to be very common amongst the breadth of nonprofits, but foundations, depending upon how they manage their investments, they may want to take a good close look at this. And then also a lot of the costs associated with that, the selecting and monitoring of external investments. If that's been, quantified in some aspects, that would be included as well. But it's definitely not the accounting staff, reconciling accounts. Those are not internal investment expenses at all. So I don't want to get that confused. It's not very common for internal investment expenses to be tracked just because we haven't had the mindset. So it's definitely something that you're going to want to look at as the possibility of having some of that being allocated. And the complexity, it just depends upon the nature. As I said, foundations, they may have some of this dependent upon what their practice is. So what to consider, definitely the choice on your report, whether you want to net it or still have the individual components, your choice, but you'll still need that information when it comes time to filing the taxes. So the cash flow statement, the real big change on the cash flow statement, so big I had to put it in quotes. Currently, there's two methods to providing a statement of cash flows. There's indirect, which is what Maynard does. We primarily do indirect. And then there's the direct method. So with a direct method, there's generally an additional reconciliation that you have to include if you choose to do the direct method. Well, the big change with the statement of cash flows is that little reconciliation that you were required to do when you did the direct method, you no longer have to do. So if you're doing the indirect method, and for those of you who want to know what method that is, it's on your statement of cash flows at the top portion of the statement of cash flows. We're showing, the change in accounts receivable, the change in accounts payable, the change in this liability or this receivable, and then we get down to, net change for operations. The direct method, it would start out with payments, paid to customers, payments made to vendors and so forth. So if you're doing the direct method, the only change is you don't have to do the reconciliation more. So you get a small win there. But I think the vast majority of nonprofits fall under the indirect method, so they're not going to see any change as far as their statement of cash flows is concerned. So transition guidance, all provisions apply in the year of the adoption. So if 12/31/18, if that is your first year under the new standard and you're going to report, everything that we've talked about has to be displayed, and not just fiscal year 12/31/18, but if you're comparative, each year needs to be reflective. The only easy out that we get on this implementation is that as far as comparative information is required, you can have a choice whether to omit the prior year information relating to the functional expense reporting, the statement of functional expenses, and then the disclosure about liquidity. Those are the two areas that you have an out where you can omit those. And I believe the vast majority of organizations, if they haven't had those in the past, which the liquidity they haven't, but I'm pretty sure that most organizations are going to choose, you know what, we're not going to do comparative for these two, and then moving forward, they'll both definitely be comparative. So if you choose to early adopt, which you could if you're a 630 18 or a 930 18 or even a 1030 18 if we have any of those out there, if you do choose to early adopt, same thing. If you do comparative, everything applies, but you still get the out on the functional reporting and the liquidity. So those you don't have to make a comparative either. So key takeaways: as early on or as soon as possible, definitely identify the areas of the financials that'll be effective. Definitely look through your policies. There's a few slides here where we hit on those just to make sure that the board and management are all on the same page. Definitely discuss board designations if you feel that that's going to be an issue, and then figure out some game plan as far as early on how you plan to address these changes, maybe education with the board or education with your staff, just trying to get them up to speed. And for some of you, maybe even a change in your chart of accounts to help with the expense reporting changes. So definitely plenty to consider here. So, and just to let everybody know, I put in the website information in case you really do want to read all 200 plus pages of the ASU. I know some of you have a hard time sleeping at night, but that is out there for you to take a look at, or look for a reference for anything that you may have a question if you just want to dig something up on your own. We do have an upcoming free webinar covering the individual tax change overview and state tax impact. With everything going on this past year and all the changes and people trying to get their minds wrapped around it, this would be a really good one to attend. So that, and it's free, so that's always a plus too. But highly recommend tuning into this. And then also, we have our Solutions Conference coming up. That's on November 28th. I know many of you have attended that in the past, and honestly, truthfully, this event just gets better and better every year. We've even added a new track this year for affordable housing, so it's just blowing up for us. So it's fantastic. So I encourage you to attend, some of your staff to attend. If you've got friends or other nonprofits that you talk about, please let them know about this and have them attend to it. It's just a great full day of just good information and good insight. So I can't highly push it enough. Want to say, hey, thank you everybody. That's me for this webinar. I do appreciate everyone attending, and hey, everybody, have a great day and enjoy the fall. Have a good day.